What are dividends? Dividends are paid out of the free cash flow generated by publicly traded businesses in the stock market. When a company generates cash, it can use that money to run daily operations, develop products and services, pay employee salaries, repay debt, and cover interest expenses. If a company is left with additional cash that it cannot effectively deploy towards internal growth opportunities, management may decide to return that cash to shareholders in the form of dividends. On the other hand, if management believes the cash can be better used within the company to generate higher future returns, they may reinvest it into new ventures or expansion activities. Instead of paying dividends, management may also choose to buy back shares, especially since dividends are taxed. Share buybacks reduce the number of outstanding shares in the market, thereby increasing the value of the remaining shares held by investors. This is the opposite of share dilution. However, share buybacks are not a good approach if the stock is trading at a high valuation, as this may lead to lower future returns for investors. In contrast, buybacks can be a viable option when shares are trading below their fair value. One drawback of share buybacks is that if the stock price crashes or the company goes bankrupt, investors receive nothing in return for their investment. So, cash dividends paid over the company's lifetime allow investors to recover at least part of their investment. Dividend growth and quality companies. High quality companies often commit to increasing dividends consistently over many years or even decades. Investing in such companies provides investors with a steadily growing passive income stream. Passive investors generally prefer a dividend growth rate of 5% or more annually to keep pace with or exceed inflation, which averages around 3% in the United States. For example, Pepsi has grown its dividends at an average rate of 7.3% over the past 10 years, with a dividend yield of 3.95%. Pepsi has increased dividends for multiple decades without cuts, making it ideal for long term investors. Growing dividends also represent an unwritten expectation among investors, which encourages company management to maintain healthy financial discipline. Buybacks, by contrast, are not expected to grow every year and are therefore inconsistent. As a result, they do not provide the same incentive for management to maintain a clean balance sheet. Sustainability of dividends. For companies to grow dividends consistently, their free cash flow must also grow every year. Otherwise, the dividend payout ratio may exceed sustainable levels, eventually forcing the company to cut dividends. For example, Pepsi has a dividend payout ratio above 75%, which adds pressure on management when allocating cash between business operations and shareholder rewards. A payout ratio of around 60% is generally considered sustainable over the long term. Companies offering very high dividend yields without positive free cash flow are likely to deliver poor results for investors over the short to long term. Some may pay high dividends simply to attract new investors, but this strategy almost always ends in disaster. Investors should be cautious of such companies. Dividend cuts and diversification. Dividends are not always guaranteed. Even high quality companies can face challenges such as increased competition or slowing growth, which may result in dividend cuts. For example, Intel, which once paid steadily growing dividends, cut its dividend by half and eventually eliminated it entirely due to intense competition in the semiconductor industry and a lack of innovation and slowing growth. This highlights the importance of diversification. Investors should avoid putting all their eggs in one basket and instead hold a diversified portfolio of quality dividend paying companies. Dividend reinvestment. Many investors prefer dividend reinvestment, which is similar in effect to company buybacks. In this case, the investor believes the company will continue to perform well for decades. Dividend snowball effect. When dividends are reinvested, they are used to purchase additional shares of the company. These new shares generate dividends of their own, creating a dividend snowball effect. Over time, especially after 10 or more years, this effect compounds exponentially, significantly boosting both portfolio value and dividend income. Investors may also choose to reinvest dividends into other companies or ETFs instead of the original dividend paying company. For example, an investor could reinvest dividends received from Verizon into Google shares. Are dividends really important? Companies like Google and Meta, which historically did not pay dividends and relied solely on buybacks, have recently started paying dividends. This shift highlights the growing importance of dividends even among major growth companies. Typically, mature companies begin sharing excess free cash flow with investors through dividends. Early stage companies usually do not pay dividends because they require more cash for operations and growth, and reinvesting profits may generate higher returns for investors. Dividend paying ETFs. For example, VTI, Vanguard Total US Stock Market Index, holds nearly 4,000 publicly traded US companies. Capital is allocated proportionally based on company size, with Apple accounting for about 6% of the fund. Smaller companies have smaller allocations. Dividends paid by all holdings are aggregated, resulting in a dividend yield of approximately 1.12%, which has grown at around 6% annually over the long term. Since the yield is relatively low, some investors prefer higher dividend income and therefore look for ETFs focused on dividend paying stocks using higher quality metrics. One such ETF is SCHD, which yields about 3.78% and has achieved a dividend growth rate of 10.5% over the past 10 years. While this performance is impressive, the key question is whether such extraordinary results can be sustained in the future. Why dividend investors sleep well at night? Dividend reinvestment provides peace of mind during market downturns. If market crashes by 50% and stock prices fall, investors can reinvest dividends at lower prices, allowing them to purchase more shares for the same dividend income. As the market recovers over time, this accelerates the dividend snowball effect. Instead of panicking during market crashes, dividend investors in quality companies often view downturns as opportunities to accumulate more shares, which in turn generates higher future dividends. Do dividends fall during market crashes? Dividends may decline during severe downturns, but they are determined by company management rather than daily market fluctuations driven by buyers and sellers. As a result, many high quality companies continue paying or even increasing dividends during market crashes. For instance, during the 2008 to 2009 global financial crisis, the overall market declined by up to 56%. Yet, dividends from VTI ETF fell only by around 15% and recovered quickly to pre crisis levels. Practical example. Assume an investor invests $10,000 in SCHD. The first year dividend income would be approximately $378. If dividends are reinvested and if we assume optimistic but not guaranteed future performance, with 5% annual stock price growth and 10% dividend growth over 30 years, the portfolio value would reach approximately 390,000 with annual dividends of 47,500 in year 30, which is exceptional. With 8% dividend growth, the portfolio value would be around 220,000 with dividends of 16,500 in year 30. With a lower 6% dividend growth, the portfolio value would be about 146,000 with dividends of 6,600 in year 30. These examples demonstrate the long term power of dividend growth. At 6% dividend growth rate, if dividends are not reinvested, the final portfolio value would be approximately 43,200 with annual dividends of just 2048, clearly highlighting the impact of dividend reinvestment and the snowball effect. Thank you for listening.